So how many of you are actually directly either responsible or involved in the financial management of your CDBG program? Got a large crowd. Normally we have about 5 or 6 in the crowd, okay? So those of you who are involved in the financial management aspect, you are probably have heard or are familiar with the super circular, right? 2 CFR Part 200, okay? That will be one of our discussion items under financial management. And again, all of these things are kind of at a bird's eye view. But we can dig in a little, we do dig in a little deeper on certain areas that we think are important for you to maybe even dig deeper, okay, in the implementation of your program, such as, bless you, such as the indirect costs for subrecipients, because we know you're probably getting bombarded with those questions all the time, okay? Okay. So we're going to start off with general administration versus activity delivery costs. And this is always a subject that grantees have a hard time grasping. Okay, I have an expense. Does this expense belong to administration, or can I bill it to the actual activity? There is a CPD notice that came out. It is CPD 13-07, okay? And it does a very good job of describing what an activity delivery cost is versus an administrative, planning and administrative cost, okay? Normally, your planning and administrative portion, your 20%, becomes very valuable, right? So you try to make sure that as much of the costs are going to the activity delivery. But you have to make sure that it is an eligible activity delivery cost. You can't just throw it in there and expect that it's not going to be found. And you're going to have to repay it, or you're going to have to shift it over to your admin category. So that particular CPD notice kind of talks about the difference between one and the other. And in the next few slides, we're going to talk a little bit more about the difference between planning and administrative costs versus activity delivery costs, okay? Also remember that our admin costs are capped at 20%, okay? And we're going to go through 2 different tests for admin. We have we'll go through both of the tests in the upcoming slides as well. So for general administration and planning costs, you have basically 2 options for charging salaries. You have the entire amount. How many of you are working all full-time on CDBG admin or CDBG admin? Okay. So yours is real easy. Your timesheet basically, let's say it's 8 hours a day, it's 40 hours at the end of the week, right? Your timesheets, your allocation is basically 100% CDBG. But most of the time what ends up happening is you may be working part of it's CDBG, maybe some other program, maybe it's home, maybe it's something with general funds, maybe it's housing rehab. And so your time is being divided into many different activities, whether they're funded with CDBG or whether they're funded with other funding sources. In those cases, we look at a pro rata share, but you're doing it via timesheets. You must document your time on a timesheet. So you'll have every funding source, CDBG, or every activity. So I'll have CDBG, I have housing rehab, I have commercial rehab, and then I have some general fund activity. You have to track every day how many hours you worked on each activity, okay? Very important. Now, you do have direct and indirect costs, and we'll talk a little bit more about direct and indirect costs A lot of people want to get reimbursed for utilities, for rent, other type of indirect costs, and we'll talk about a cost allocation plan. How many of you actually have a cost allocation plan? 2, 3, 4. I have a maybe, okay. That's not unusual, okay? Why? Because cost allocation plans, number one, are very time consuming, and number two, they're not inexpensive, right, to develop. Even though you have a cost allocation plan, you must maintain timesheets, okay? You must maintain timesheets. And at the end of the year, you must reconcile your records, okay? It's not just the cost allocation plan said I was 25% CDBG, and therefore that's what it is, okay? You take the timesheets, you then reconcile how much actually was it for the year. You may find that it was 24%. You may find it was 28%. So you reconcile those numbers, and that's what you actually end up doing at the end of the year. So you have to try to do it just before the end of the year because in your last draw, you want to make sure that you're not overdrawing, okay? And if you are doing a cost allocation plan, make sure that it's approved through a federal cognizant agency, okay? That's important. So again, back to that slide. It's very important that you're documenting things, and that timesheet is probably the number one finding that we see when HUD comes out to monitor grantees. Lack of timesheets. There's no connection between what you requested in reimbursement for time versus what was actually worked. Okay? So there are other eligible administration and planning costs. We look at public information. Fair housing, do you remember that fair housing was also under public services yesterday? And we talked about how you can fund it under either category. But if you fund it under admin, you don't have to obtain any beneficiary records. You do have to obtain, their hours, timesheets, their actual costs for the services. But under public services, you would have to be collecting the beneficiary data, okay? Now, just because it's an admin and you don't have to collect the beneficiary data, we still collect it, okay? And then we put it in our narrative. Why do I put it in my narrative? Remember we talked about telling your story? It's important that you tell your story. And fair housing councils or agencies, it's amazing the numbers that they produce, right? I mean, we fund a fair housing agency for $30,000, and I think the total number of beneficiaries is like 750, okay? So it's telling the story, and that's important. Okay? The preparation of your consolidated plan, submission of applications for federal programs, administration expenses to facilitate housing. Also for the overall management of other HUD-type programs. How many of you have home? Okay, so as you know, you only get 10% for admin under home, right? And those go so fast. This is a way of being able to fund some of the home admin services under CDBG. If you have excess CDBG admin money, it can be used to do home admin, okay? Planning and policy work and studies. Okay. Some costs may be charged to activity delivery cost, and because your admin dollars are so valuable, sometimes we're looking at, is this an expense that we can do as an activity delivery cost, okay? And so here's some costs that are related to administering programs. And housing rehab is one of those activities where a lot of these costs should be activity delivery and not admin, okay? As an example, inspection services, reviewing the application. Whoever's administering that program, the time that they take to, process paperwork, maintain the file, close out the file, recordation fees for preparation of loan docs. All of those are really activity delivery costs and should be billed to that, okay? The key again is making sure that there's a connection. Everything you do, if I'm receiving an invoice for a title report, I want to make sure that I'm noting that that belongs to that activity, okay? You link it. And one of the things that I find grantees to be deficient on is finance does a very good job of capturing what you submit to them, okay? But there are times that for whatever reason, something is misclassified. It happens, okay? You have to understand finance is getting 10,000 bills coming in and they're trying to classify everything to the right number. Take a look at your general ledger before you do draws, before you say this is what it is for that, okay? And this is a best practice that I want to share with you. So as you're going through that general ledger, and I'm looking at my housing rehab, or better yet, I'm doing a capital project, okay? I'm doing a renovation to our community center. And so I go through that general ledger. I'm saying, okay, what's hitting that account? Okay, we have staff time, they're preparing the bid documents, and suddenly there's ABC Engineering, okay? When I see ABC Engineering, the first thing I think about is, did they procure? Okay? So it's an opportunity for you to make sure that before you're drawing these funds down, that every expense has complied with the requirements. Did they procure correctly? And if they did, then is there an agreement with that particular agency or that particular engineer that has all the pertinent clauses, okay? So it's a way of making sure, again, you're not drawing, you're not paying for something that later becomes ineligible. That's just my best practice. And it doesn't take very long to just go through it real quickly. And once you know ABC Engineering has been procured for the next time you see them on the general ledger, you're like, okay, yeah, I already know we've got that documentation. It's done, okay? So again, that's just my best practice that I'm going to share with you. So again, all of these things are examples of project delivery, activity delivery costs. For the home project delivery costs, you can include housing counseling, you can do loan processing, management of TBRA. So these are all kind of home type activities, okay? So we talked about two tests for the administrative cap, right? The first test is what's always existed, and that was, we'll talk a little later about FIFO, which is first in, first out, okay? You all have probably heard that acronym. Under that process, we always used to look at obligations. So you're awarded your grant, your annual allocation. Your annual allocation is $100. You would immediately take that 20% and say, $20 we're going to obligate to admin, right, in IDIS. That's obligation. That's the first test. So what you actually have seen in IDIS in your PR26, some of it comes from the fact that you're obligating that money and then what you've actually spent under that particular grant, okay? Test 2, which we'll go through later, is a little different. So again, remember, test 1, obligation, okay? So again, your obligations cannot exceed 20% of your annual entitlement. The cap is imposed through the annual appropriation. So it's not part of the statute. It's actually part of the appropriation. So at any point, believe it or not, if they appropriate a new amount of money, they can just say it's 15%. Okay? But it's been pretty consistent since it began. It's always been 20%. Okay? If you want to look at the regulation, you can find it at 24 CFR Part 570, 200. Note that the cap is, for those of you who are states, is going to be calculated a little bit differently. Yes?
Back a slide. The TBRA management can be a project delivery, but that's a whole right. What matrix code would you use when you draw down the funds?
For home?
Well, you're in CDBG and you're paying for the management of TBRA.
For this one?
Yeah.
Well, this is admin costs. You're just putting under admin. What is basic? Right. Oh, for activity. I see. Okay. You actually have to, there should be a TBRA matrix. Yeah, there should be. Yeah. What is it? 21. Okay. Yeah. I'm still thinking 2 slides back. Okay. So here's our calculation. If we look at our entitlement of $1 million, we actually received $50,000 in program income. Our total amount is $1,050,000. We multiply that by 20%. That's the maximum that we can obligate, okay, under the planning and administrative category. As we continue the calculation, so here we're talking about total cost under planning and admin for the year. So this is what we actually had budgeted. You remember yesterday when we went through the public service calculation, we talked about unliquidated obligations and from prior year and for next year, same concept, okay? So I won't describe that concept again, but here we'll see that we have unliquidated obligations at the end of the program year of $35,000. We have subtract unliquidated obligations as of the end of the preceding program year, okay? That gives us $165,000 compared to the maximum calculated to determine planning. So are we okay? We are okay. Okay, we're quite a bit under. Okay. Okay, we're going to talk a little bit later about grant-based accounting. Are you all familiar now with grant-based accounting? Yeah. For those of you who are in the financial community, this is the best thing that could have ever happened to you, right? So in the past, when we worked with FIFO, and I'll talk in more detail later, but financial people can never connect the dots. It wasn't like, okay, for that year, we budgeted this amount, we spent this amount, but it doesn't reflect in IDIS. Why? Because IDIS used to bundle everything as one account, okay? And so, fortunately now we have grant-based accounting. So as a result of grant-based accounting, they've added a second test that we have to go through. What was the first test? What were we testing for? Obligations, right? Here we're actually testing for expenditures. So no more than 20% of each grant can be spent on planning and administration. Now, the test is actually going to occur when you close out your grant. Yes?
But being new to CDBG entitlement, I'm not familiar what you mean when you say close out the grant. And is there a report in IDIS that would show me which grants have been closed out and which one haven't? Which grant, I'm assuming grant years, you mean?
So IDIS is going through some changes right now to address, it always is, but To specifically address the whole grant-based accounting, there's already things in there, but the reports modules, I haven't seen one come out yet for that, but it should be coming out. If it hasn't come out, it will come out, okay? What used to happen in the past, and those of you who have been doing this for a long time, we never closed out a grant. The only time we closed out a grant, if it was a special grant, NSP, HHRP, the homeless programs. Those were special appropriations that were made. We always had to close those out. But we never closed out CDBG because it was FIFO. It just kept, yeah. We will have to close out, by the way, all of our prior 2015 grants at some point. Okay, and there's actually a slide that shows that. Okay, so just remember that this is, we're now having to be tested on the overall grant. So when we talk about grant, we will talk about it later today. What is the grant? In the past, it was kind of all mumbled together. Now, when we say 2016 grant, literally it's 2016. And I'll use an analogy when I go through it, but I might as well share it now. It's kind of like having checkbooks, okay? Where in the past you had one checkbook, and as HUD would allocate money to you, you'd throw it into that checkbook, okay? And it would grow, it would shrink as you're making expenditures, but you're always taking from that checkbook. And when you would issue a check to somebody, it would take from the oldest money first, okay? Now, what we're doing is we're saying, okay, here's this checkbook for 2016. It has money in it, and that's all you're going to get in terms of money, other than any PI that you might receive, okay? That's that checkbook. 2017, here's a new checkbook. This is your 2007. Separate checking accounts, okay? And each one of those balances out. When you want to, and we're going to talk on a slide where it says if you're going to do voucher revisions, you can only do it within that checkbook. You can't do it with another year's checkbook, okay? That's your pot of money. That's your account. It may seem like it's a pain, but trust me when I say reconciliation is so much easier because now you can connect the dots, okay? Very easy to do, okay?
So in this checkbook system, what if you don't expend all of your monies? Do you get to take them, withdraw them, and transfer them to your 2017 checkbook?
No. But an activity can have 2015 checkbook money, 2016 checkbook money, 2017 checkbook money.
You spread your activity over the...
Sure. But you're always maintaining that checkbook individually, okay? So does everybody kind of understand this concept? And at some point, what you're closing out, when we say you're closing out that grant, you're closing out that checkbook because you've used up all of your money, nothing left. You're saying, here, bank, I'm giving this back to you. I'm done, okay? Does that analogy kind of, yeah, I find that works in trying to figure out how this whole grant-based accounting. Pre-award costs. Okay, so this is an interesting one. This is another tool that is going to be added to your tool belt. What is pre-award costs? They're basically costs incurred prior to the effective date of the grant agreement. Grant agreement effective date is the latter of program year start date or the date that the con plan is received by HUD. And I'll skip this for right now, but I'm going to give you what that concept is, and then we'll talk about these last 3 points. How many of you have ever had a project that is ready to go? You're getting ready to adopt your action plan. That activity is part of that action plan, and let's just say you're a July 1st through June 30th grant year or program year, okay? You're submitting your action plan. It's the latter part of April, early part of May. You're ready to go. And everybody's saying, when can we spend the money? When can we spend the money? And you're like, got to hold on. Got to wait till we get our agreement. Got to wait till July 1st because that's when our year starts. You don't have to wait. Okay? So what happens is, as long as you include it as part of your action plan, I would disclose in my action plan, letting my residents know that as soon as I submit my action plan to HUD, and I am notifying my HUD rep, Mr. Smith, I am going to be using the pre-award cost rule to actually start working on this street improvement project because it's ready to go. I'm submitting my action plan. You now have it. You can now spend 25% of your grant or $300,000, whichever is greater, towards that, till your actual agreement comes in, till your fiscal year starts. Didn't know that, right? Yeah. Program income. How many of you actually generate program income? Yeah, it's about the right number. Okay. So what kind of activities do you generate program income for? Housing rehab. That's probably the most common, right? Home buyer program is probably the second most, and then economic development. I heard economic development out there somewhere. Economic development is probably the third most received PI, okay? So this is basically money that's returned to you through one of the CDBG activities that you implemented, okay? So it's money that comes back as a result of what a subrecipient is generated by a CDBG activity, such as proceeds from a sale or lease of real property, gross income from use of rental, real personal property, and the most common ones are right up here. So payments on interest and loans made with CDBG. So these are rehab loans, right, that are being made. Proceeds from sale of loans or obligations secured by loans. So this may be a home buyer type program. Interest earned on program income pending its disposition. So let's spend a couple of seconds on this one, because this is a question that comes up all the time. How many of you actually have a revolving loan account? Okay. So this is where it gets a little weird. I see a couple of heads. Yeah. You probably know where I'm going with this, right? So any interest earned on program income is program income. Any interest earned on a revolving loan program income is not program income. That must be returned to HUD. Okay, what is not program income? Income received in a single year, not exceeding $25,000, and we're going to talk a little bit more detail. There's a slide for this, okay? And that's called miscellaneous revenue. Okay, yeah, it's miscellaneous revenue. That's a good name to put on it, right? We have income generated from some Section 108 loan activities, and if you have a Section 108 loan and you want to know what the exception is for program income, I'm going to give you the citation. It's 24 CFR Part 570.500 A4 Roman numeral 2. So if you have a Section 108 loan and you want to know if you have any exceptions, go to that section, okay? So I can repeat that again. 24 CFR Part 570.5000. And then it's parentheses A, parentheses 4, Roman numeral 2. So if you do have it, make sure that you look up that citation. Okay. Proceeds of subrecipient fundraising, funds collected through special assessments. Again, Chris went through special assessments, and we talked about low income, and when you're getting repaid from the the people who were not being assisted with the funds, not program income. Subrecipient proceeds from disposition of property 5 years or more after closeout. And we're going to talk a little bit more detail in change of use. In fact, it's the last slide on this. So it'll talk about when a property is sold after 5 years of grant closeout. Okay, again, this is why you want to close it out as soon as you can, because that's when the clock starts. So if a subrecipient generates revenue from in excess of $25,000 from the sale of a property, technically it's not considered PI anymore. Okay? Okay, the use of program income. The best way to describe this is to say, think of it as new money that was allocated to you. What you can do with it is exactly what you can do with your original grant money, okay? Nothing more, nothing less. You can also take your 20% admin money from that program income for which year? Current year. You can also take 15%, which is not on 15% of the funds for public service for which year? Next year, okay? So again, think of it as new money, okay? Which is why when we look at the calculations, you remember that it says here's your allocation and then here's your program income and then it totals it out and then it starts all of the other calculations because it looks at it as part of your original bunch of money that you have for that grant year. Yes?
If you were going to take 15% and use it for the next year, do you have to receipt it then, or do you receipt it when you're going to apply it?
No, you receipt it on that year. The system knows when you're running like your PR26, it looks at all your PI from prior year, and it says, okay, when I do the calculation internally through IDIS, it's looking at that grant year plus any PI that was received, and it takes 15% of this and it adds it to the 15% for that year, and it says, here's the maximum you can use for PI, for public service. 9 times out of 10, grantees won't do that because it's already, it's more confusing. I've even heard grantees that will say, well, we don't want to give false expectations that we're going to have this money every year. So we don't want to increase the amount of public service because then next year we're going to have to cut somebody out or we're going to have to reduce everybody. And we don't want to do that. We want to keep it consistent. So, that's a decision that you as a grantee have to make. Okay? Miscellaneous revenue. Okay, this is the one that gets everybody excited. So it says on the slide, miscellaneous revenue is a total amount of funds earned in a single year from all sources, including revolving loans, that is less than $25,000 that is not program income. So let's say that you are implementing, you have a housing rehab program, and you had a program that years ago was giving out loans, but now it's just grants. And so every once in a while, somebody will come knocking on your door with a demand for payoff saying, I need to pay off this loan. I have this $10,000 loan for rehab that I did 10 years ago, okay? If you are receiving less than $25,000 any one program year, you don't have to report it as program income. Basically, it becomes miscellaneous revenue. And you can do, basically it's do what you want with it. It no longer has the regulations, the CDBG regulations tied to it. I always tell grantees, even though you aren't required to put it back into CDBG type of activities, you may fall short every year on your admin. Use it for admin purposes, okay? even though you can do it outside of the system, you're not reporting it as program income, you're actually putting it into your general fund, but use it for that purpose because that's what generated the money, okay? Also, so any funds that are earned from certain types of activities that are carried out by certain nonprofits, and Chris went over community-based development organizations, right? And how they're able to keep their PI. It's not considered PI. And then we have nonprofits serving local development needs, and that's a state program only. So those are you who are state, that applies to you. Okay. So here's a slide. We must use PI prior to drawing new CDBG funds from the line of credit at HUD. You cannot hold your PI for any specific type of project and say, I'm going to bank this here because I want to use it for this particular use. If that's what your intention is, you should be setting up a revolving loan account, okay? And we'll talk about revolving loans in a couple of slides. So under 57504, there's actually some language that says if you have excess program income in hand at the end of the program year, then you must return that to HUD after you've deducted certain costs or certain future expenses plus 1 month's worth of your typical draws that you have, okay? So we'll look at the formula in the next slide. So actually it's 2 slides from now. So what it does is it determines your aggregate amount of program income that's held. So let's say you have, $100,000 in hand, then you're going to subtract immediate cash needs. So if you have payments that you have to make, you have a revolving loan fund, you're going to subtract that. You're going to subtract any lump sum drawdown balances. You're going to subtract any cash used as security for 108. After you've done all of that, then you're going to divide that by 1/12, or anything in excess of 1/12 of your recent entitlement must be remitted. So your entitlement is $1 million. It would be, 1/12 of that. So it'd be whatever that number happens to be, 8,666, I think, okay? So anything above that number would have to be remitted to HUD. And so let's look at that calculation. In this example, we have $250,000 in hand of program income, okay? Immediate cash needs. We have payments we have to make in the amount of $20,000. We have a revolving loan balance of $180,000. And we have to do a lump sum drawdown, and we'll talk about lump sum draws coming up. But that's 0. Cash held for 108, 0. The total amount, our total balance then is $50,000. So even though we have $250,000, really we're going to be making these payments out fairly quickly. Those are obligated already, okay? That leaves us a balance of $50,000. Our second calculation then takes our annual allocation, divides it by 12, that gives us $160,000. This amount, any of this amount that's in excess of $160,000 would be returned to HUD. Does that make sense? Pretty simple math. So what would happen if I was to subtract, if let's say I didn't have a revolving loan account and this was 0. My total here would then be $230,000, right? How much would I have to return to HUD? $70,000, okay? Again, real simple math. Does anybody generate this kind of PI? I hear one that's going, maybe. Your neighbor does? Okay. Yeah. So you should be following this rule, and many people don't follow this. They just keep it. At the end of the year, you should be doing this review because it will be a finding if you don't if you don't send the excess back. We had some questions.
I'm new to the directorship for 2 months, and we've got a large summer program income. How does it inform us of planning its expenditures? So I had to submit a workout plan, and that workout plan has been utilized on that program income. I should be doing that calculation before I did that plan?
Well, here's what happens. You are returning those dollars. Yes, you should have. You're returning those dollars, but they're still in your account. You still get to reuse them. It just means that you don't have them in your bank account making interest. It goes into what is called the bucket. Then from there, what happens is you start funding activities. Does that make sense? Okay. Float funded activities. Here's another tool for your tool belt that you may not have been aware of. Okay. Have you ever funded an activity that you knew was not going to take place for 2 years? Yeah, huh? It happens. You have pressure from your council, from your board of supervisors, whatever it may be. We want to allocate this money, and they know that it's not even enough to do the project, but they're probably looking at using multi-years of funding for it. So let's say that they're going to do this major addition to the senior center, and they're going to fund $500,000 this next year, or they funded $500,000 this year. They're going to fund another $500,000 in 2 years to cover the cost of the actual improvements. Now, by doing this, they feel comfortable that they're going to be able to move forward with it. So they're going to have the architectural and engineering and environmental and all of that being done immediately. It's going to start, okay? In the meantime, that $500,000 is just sitting there. And as a result, it's kind of affecting you. It's putting you in a tight spot with your timeliness test, right? What do? So you have the option to do what is called a float-funded activity. You have a property owner of low-income housing that comes in and says, I need to rehab the units, but I need $500,000 to do the rehab. And I'm willing, once I do the rehab on these units, I can refinance the building and then pay you right back. It's going to be about a year by the time I get this all done, and I'm guaranteeing the repayment of that $500,000. So what ends up happening is you can actually fund it, you include it in your action plan, you do the environmental, it's just like a project, but while you have that $500,000 already budgeted for an activity, you slide that one in, you get it done, you get repaid, you pull it out, and you still have that $500,000 for that senior center project. Make sense? I've never used it because I just prefer to say, okay, you know what? Cancel that activity, fund it when you're ready to fund it. Let's fund this one, and then we'll do it that way. It's just another tool should you ever need it, knowing that it's there for you. Again, it's rarely used, but you can use it. Seattle used to use it all the time. Okay, that's one agency that I knew that did use that. Revolving fund. How many revolving funds do we have? 2. Okay. So they're typically for a housing rehab. What's yours for? What's yours for back there?
Business state level, so.
Okay. Okay. So housing rehab is probably one of the most common. And then again, after that is probably economic development. And then it's maybe home buyer programs, okay? It has to be a separate fund account for a specific activity. There's a key word there, okay? That generates payments for reuse with similar activities. What it does is allows you to wall off program income, okay? So as program income comes in, normally you have a pot, and it's your program income account, okay? One big pot. When you have a revolving loan, it creates its own separate account. And let's go back to the checking account analogy. It creates a separate account for the rehab program, okay? The concept is that if you are drawing down on the public service program, it will take from the big checkbook, okay? It will not take anything from that revolving loan account checkbook. When you make a payment, if you have PI in both accounts, when you make a payment for your housing rehab program, it takes it from that PI, not from your general one. It's going to take it from this one, unless you no longer have anything here, at which point then it goes into your general pot, okay? It's a way, the concept is that it's a way of establishing a program that hopefully at some point is self-sufficient. It's running on its own. It's generating income. It's helping more. And you're not having to continually fund this activity because it's self-sufficient, okay? Does that make sense to everybody? If you do, you have to make sure it's in an interest-bearing account. And again, see the difference? Interest earned on fund remitted to HUD. And because yours did not exceed $25,000, they just considered it miscellaneous income. Okay, that's the reason why. Interest paid by borrowers and loan repayments are program income. So again, we're talking about, economic development. We're talking about housing rehab. We're talking about home buyer type programs. Lump sum drawdowns. If you run a housing rehab program, this is something you might consider doing. Especially if you have a hard time getting checks out to contractors because your payment process is not very efficient, okay? And we see that every once in a while. When you're dealing with a housing rehab program, you're dealing with contractors who don't have the ability to wait, 45 days for a payment. They're small time. So they need to be paid, fairly quickly. But I've seen, grantees that it takes 45 days because it goes through various hands, it goes through finance, it goes through what's called a warrant register, and then it goes to council, and then it goes, by the time all is said and done, it's 45 days later. You can actually do what is called a lump sum drawdown, okay? And it's used to establish a rehab loan fund with a private financial institution. Subject to certain limitations, you cannot exceed the grant amount for your specific program. So if you've allocated $250,000 for that program, that's the maximum that you can actually deposit. Cannot be used solely for investment. Rehabilitation administrative costs are not eligible. This is just the actual construction, the loan portion of the construction costs, okay? Yes. So it's a way of making sure that those funds are deposited in there. Now, if it has to go through council approval, you're getting council approval for the whole pot of money, right? You're saying, okay, we want this over here because we're going to do 5 rehabs. Or even where you're saying, okay, we're going to rehab Mrs. Jones' house for $35,000. We'd like to deposit that into do a lump sum drawdown, deposit it into this account. And then at that point, it's being dispersed, okay? And it's being dispersed much quicker. You got council approval for the overall project cost, not the disbursements of every payment, okay? So it's a valuable tool in making sure contractors are getting paid, on a timely basis. Continuing on lump sum drawdowns, if you are going to do the lump sum drawdown, make sure you have an agreement with that lending institution. The funds must be committed within 45 days. So you can't just deposit this money and let it sit there without any activity. You're depositing it there because you already have something in mind. It's already getting ready to go. And you're starting to, you're getting contracts ready where you're committing those dollars now to Mrs. Jones' rehab project, okay? And that should happen within 45 days. Disbursement must begin within 180 days. And the financial institution must provide you with some considerations in exchange for you depositing these funds into their account. The account must earn interest, and any interest is considered program income. Okay? Would anybody ever consider one of these? Yes?
What do you mean by specific considerations?
So the regulation isn't really, what they're basically saying is, what are they going to give you in exchange? Are they going to track every payment? Will they be giving you a detailed ledger? So we work, for example, with an escrow company sometimes that will do this for you. The only difference is that those grantees don't do the lump sum drawdown because they actually front the money. Whereas this, you're asking HUD to front the money, right? So we use escrow companies where we say, okay, we're going to deposit this money in there, but number one, we want you to, track every payment. We want reports, and we want them in this fashion. And they actually will even record the deeds of trust and the promise, do all of that. So they'll warehouse them for us so that when there is a demand for payoff, it goes through them. So those are types of things that you might consider when you say specific considerations. There's no specifics in terms of what that means or a definition in there, but yeah, good question. Okay. Timeliness. Who's on a July 1st, June 30th? We just got through ours, right? What was it, Tuesday? Tuesday is a magic day. Okay, so here's a rule. You're not allowed to have more than 1.5 times your allocation in your line of credit 60 days prior to the end of the program year. So you look at that year's grant. So we're talking about 16-17 grant for those of you who are July 1st. Your grant amount is $1 million. You cannot have more than $1.5 million on May 2nd in your account of unexpended funds, okay? If you want to see how much you have available of unexpended funds, go and pull a PR 56. You know it by heart. Yes, a PR 56. I will give you some advice if you are running real close. Do not do it the day before. And there's a reason why. IDIS isn't always great at regenerating that information. And it typically, when you do a draw, it won't reflect that day. It won't reflect until the next day. Sometimes 2 days. That's exactly what I was going to say. There are times. And I don't know if it depends on the time of the day or why. Sometimes, is it the time? Yeah, so I always say, do it 2 days in advance so that because your HUD reps are going to actually go to your PR 56. That's what they're going to look at. They don't have access to your system, And whenever I do work with a grantee that's, last minute, I say, do screenshots of that draw, just to show that you did it. It's not reflected, but you have some proof, okay? So important that you do that. But if you are in that position regularly, you need to kind of change the way you do things. In working with many grantees that have had issues with timeliness, we work on changing the types of activities that they fund to try to do more shovel-ready projects, okay? Sometimes you have these big projects, and that's all great, but bigger projects take a long time to develop, okay? And maybe the right, and every community is different, but the ones I tend to work with, I'll tell them, do some real short, quick projects, some medium-term projects, and maybe one that may be a little bit longer. So at least you're drawing on all these others while this one big one really takes place. But plan correctly, because if you're consistently in this situation, then you may not be looking at the projects and which projects to fund correctly. Okay? Make sense to everybody? Yes?
We've never been in that issue before with timeliness. This is the first year that it's occurred. And the reason is that HUD, and I'm going to ask you whether or not you know the reason why HUD changed its formula to include program income in consideration.
Well, I've always thought that PI was a part of it, but
You were the first time without them notifying us prior. 3.3.
okay. Wow. Well, the only thing I can say is if you don't meet the timeliness test, number one, you're going to get a nasty letter, right? You're going to be asked to do a workout plan. And that workout plan basically is looking at, okay, you've got 3.3 million over, plus now you have to count your next year's allocation, and how are you going to meet it 12 months from now? Uniform administrative requirements. This is where we get to the good stuff. So you must comply with the uniform administrative requirements that are now unified under what is called the Super Circular, 2 CFR Part 200. In the past, you would actually have to be working with multiple OMB circulars depending on who you were monitoring, depending on who you were assisting, okay? A subrecipient had different requirements than you as a grantee, which had different requirements than an Indian tribe that had different requirements. So these things were all over the place. And for the same thing, you all had different requirements. Somebody with a bright mind out in OMB said, stop it. Let's unify this. Why are we all not playing under the same rules, right? It's the best thing that could have happened. Now we all play under the same rules. And so it's called the Super Circular. Now you don't have the OMB A87, A85, A110, A122, A133, right? That, okay, which one am I doing today? Okay, that's what the rules are. So it's definitely making things so much easier. And so when we talk about 2 CFR Part 200, we're talking about non-federal entities, which are described as county, city, and subrecipients, okay? We all play under the same rules. So when we talk about cost principles under 2 CFR Part 200, we talk about the three-legged stool. And the three-legged stool is, are costs reasonable, allowable, and allocable? Any cost that is incurred, or that is to be incurred, you should be asking yourself these 3 questions, okay? I remember many, many years ago hearing about, I think it was NASA paying like $700 for a toilet seat, okay? Yeah, years and years ago. And after inflation, that would be the equivalent of probably $1,500 today. Yeah. So when you hear stuff like that, you ask yourself, was that reasonable? Okay. And we'll talk about all these 3 in the next few slides, but those are the questions you should be asking yourself. Is it reasonable, right? Is it allowable? And can I allocate it to a specific account? Did I budget for it? Because if you didn't, then you can't allocate it to anything, okay? All right, so we'll talk about these 3, starting with cost reasonableness. Is it reasonable? So is it reasonable when it does not, it's reasonable when it does not exceed what a prudent person would incur under similar circumstances. Now you notice that there's not a real hard definition of what it is, but it's what a prudent person would incur, okay? And I think we all agree that a prudent person would not pay $700 for a toilet seat, okay? Consideration should be given to these issues. Is the cost necessary and ordinary? Were prices comparable for similar goods and services? Now, I'll use this one here that I just read off. How many of you are involved in working with Public Works when they bid out a project? How many of you do housing rehab? Don't you do your own internal cost estimate? And then you compare what the bids came in at with that? What are you doing? You're comparing them to what, similar goods and services. You've done these projects before. You've done, 50 rehabs in the last 2 years. You know what it costs to replace a roof. You're comparing it, okay? You're making sure that the prices are comparable for other similar goods. So those are the types of systems that you should have internally to make sure that you're meeting the cost reasonableness requirements. Did individuals act with prudence? Were there any deviations from set policy? This also incurs not only the regulations, but you all should have policies and procedures in place, right, for procurement of goods and services, for any time you're doing anything like that. And so make sure that you're following your own requirements. And when we get to the procurement slide, that's one of the things you have to do. Yeah, HUD establishes procurement requirements, but you have your own. And most of the time, I rarely see where HUD's procurement requirements are stricter than yours. Rarely do I see, okay? How many of you can go and spend and acquire something just by calling 3 different vendors for $150,000? You can under the OMB requirements, okay? It's small purchase procurement. Yeah, so see how sometimes we have to follow your own because yours may be stricter. And when HUD comes out to monitor, they're going to look at the HUD recs, and the first thing they're going to ask for is, can I see a copy of your procurement requirements, your procedures? And they're not only looking at, did you meet HUD requirements, they're looking at, did you meet your own, okay? Okay. Allowable cost. So we talked about reasonableness, now we're talking about allowability. Under 2 CFR Part 225, it identifies what's allowable and what the unallowable costs are. Costs that are never allowed, we're looking at entertainment, alcohol, bad debts, other costs that may be allowed, but depending on conditions of funding sources. This is again the big one, that you're not paying for entertainment costs. It's pretty straightforward, right? I mean, a lot of this is common sense, to be honest with you. Criteria for allowability must be reasonable, must conform to limitations, must be in accordance with the general accounting practices, okay? Must not be included under any other federally funded program. So you can't be double dipping. Must be adequately documented. And documentation is important, okay? When they come out and monitor you, they're going to want to make sure that, okay, was it allowable? Was it reasonable? Okay, and that's where you're going to use your own internal estimate to show, yeah, look, I did my due diligence. I'm documenting that I went through that three-legged stool process, okay? Records must be supported by source documents. Explain the basis of cost incurred, actual dates of expenditure. Examples include canceled checks, paid bills, payroll. What we're doing here is we're connecting the dots, okay? You should never be paying out anything unless you have supporting documentation. Now, yesterday we talked about subrecipients and canceled checks, okay? Again, it's one of those things that initially you want to start collecting because you want that connection. But after a while, you can say, look, we're going to go out and monitor you, and at that point, I'm going to get a copy of your canceled checks for a specific time period that we're looking for. But internally, you want to make sure that you are documenting every step of the way, okay? All of your dots are being connected. And not only internally, but that these are connecting to what program do we use to report to HUD? IDIS. Everything has to match, okay? Okay. Okay, cost allocability. Say that 3 times quickly. Okay, you want to determine where to charge costs, okay? Most of you, we indicated, did not have a cost allocation plan, correct? So you have a number of ways, you have a few ways of allocating cost if you don't have a cost allocation method. More specifically for direct and indirect costs, okay, and that's financial management, by the way. There's a lot of acronyms here. So how do you cover your cost? Does anybody include rents, utilities, all of those things as part of your reimbursement from HUD? You do? And do you have a cost allocation plan? You do. Perfect. Perfect. Okay. So there's a few, though, that don't because they don't have a cost allocation plan, right? Okay. We're going to discuss a process called de minimis. Okay? This was the question that was brought up earlier that on the parking lot about, we have our subrecipients hounding us about being able to get reimbursed for indirect costs. Okay? Under the 2 OMB, the Part 200, 2 CFR Part 200. This is a new element in which you are, anybody who's asking for this, you must allow them to use this. What is it? Okay. It allows you or a subrecipient to automatically take 10% of the modified total direct cost as indirect costs without any documentation. Without any documentation.
Admin fee, and then call that.
You might say that.
So it's establishing a 10% minimum indirect rate as opposed to going through that whole process of getting an established indirect rate.
Correct.
And the modified, I'm sorry?
Couldn't have put it better myself.
So the modified direct cost, is that just a percentage of what you're paying? If you're paying 10,000 for salaries, you can pay an additional 1,000 for
Indirect
costs.
Correct. Correct.
So there's a CPD notice 16-04 that if you go to page 12, actually talks about the de minimis methodology. Sure. CPD notice 16-04. Page 12, it starts. And it tells you what you need to do if you're going to do this. Read the, yes?
It's because the OMB, it impacts ESG, home, CDBG, any federal program that we represent.
So,
Okay, great little tool. And by the way, you can use it as a grantee when you're getting. How many of you actually looked at your agreement with HUD this last year? Well, for the 16-17 year. Go back to your office and read it carefully. It actually has some language to this because it's asking you if you're going to use this. And if you are, you need to notify them. So it's a part of your agreement, and you're making it a part of your agreement with your subrecipients as well. If they're going to request that, then you want to make sure it's a part of their agreement. Additional administrative requirements. Again, you must follow 2 CFR Part 200. We're looking at two main topics: financial management standards. We're looking at procurement, okay, plus others, and including records management, closeout, property and equipment, etc. Okay, so you want to make sure you have records of all financial transactions, relate expenditures to activities, and ensure compliance with laws and regulations. And on this one, relate expenditures to activities in IDIS. Remember, this all has to match, okay? Very, very important process. Procurement. Okay, so we have some changes under 2 CFR Part 200. One of which is a very interesting option as well, kind of like the de minimis that gives you now a new tool in your tool belt. We have one under procurement, and we'll talk about that shortly. So when selecting private, for-profit administrators or buying goods and services, state recipients and subrecipients, they must all comply with the federal requirements. Okay? Everybody must comply. When you are dealing with a subrecipient, always remember that you are transferring the requirements that you have with HUD onto them. So it's not like they're going to play by different rules for procurement. Just like you procure, they procure, okay? You must, again, comply with the federal requirements, but they must also, and you must also comply with your own procurement standards, okay? Some subrecipients may not have some, they should establish them. And some of the larger ones do already have established procurement procedures. So when you monitor them, you should be checking those documents as well. So yeah, you should follow your own requirements. You should also adopt written procurement procedures. We talked about that. Cover standards of conduct and small minority business outreach, very important, okay? And Section 3. So if you are doing a project, if you receive more than $200,000 as a grantee and the project is more than $100,000, Section 3 is going to apply, okay? We'll talk a little bit more about that in an upcoming slide. I think there's an upcoming slide, okay? Others that are covered by procurement, again, we talked about subrecipients. You are passing along your requirements to them and all the responsibilities. When you monitor, you should be monitoring their process. Did they do things correctly? Developers and beneficiaries are not subject to procurement. So when you enter into an agreement, you're doing housing rehab, and you enter into an agreement, typically you're doing it with a homeowner, the homeowner and the contractor have an agreement. They don't have to procure for services, okay? Contractor's a contractor. They get to make a profit, and they can establish whatever that margin is. However, we talked about the cost reasonableness, allowability, allocability, right? So yeah, they can charge whatever they want, but if it doesn't meet those three, you can't award that contract, okay? So you should be reviewing those things anyways. Now it does say that you may elect to impose these rules via contract for a contractor. Typically, again, the three-legged stool is going to solve that issue. So we talk about methods of procurement. We have, and this slide is kind of lengthy now because we added a section here, okay? This part wasn't there before, so I'll go through these others first because I'm going to spend a little bit of time on micro purchase. The small, actually this was just small purchase. Small purchase procedures allows you to get goods and services up to or less than $150,000. That's a recent change that took place, okay? Now, many states and localities have lower units. In fact, I think everyone has lower limits than 150,000, right, for small purchase, okay? If we look at competitive sealed bids, these are your typical construction type bid projects and procurement, okay? Where you are having contractors submit and sealed bids, to your city clerk or someone of that nature. Goods and services can be equal to or less over 150,000. You can use it for less than that, by the way, okay? Competitive proposals, professional services as an example. You can use that particular process, and there's more language in the 2OMB that describes each one of these. There's definitions that will describe each one. But basically what you're doing there is, it's not a sealed bid necessarily. You're putting out an RFP for certain types of services. Two specific services that are unique in that category: engineers and architects. They must have had a great lobbying group because you cannot issue an RFP for architectural services. You must issue an RFQ, request for qualifications. And so once you do, then you are actually going to negotiate with that architectural firm in terms of what it is that they're going to charge you for those services. Now, I have seen it where they issue an RFQ and they ask them to submit under a separate envelope what they think it would cost so they can establish the baseline for the negotiations that are going to take place, okay? But you can't make a decision based on price. It's based on qualifications. You have non-competitive negotiations, which are very limited, and that basically means it's a sole source type purchase. Now, one of the requirements for procurement under 2OMB is that you are opening it up for competition. In this case, it's saying, well, you don't have to compete. You can actually do sole source. You can actually go to a specific vendor and purchase it as long as the cost is, what's the three-legged stool? Right. Right. So let's go to the micro purchase. Okay. So micro purchase, and I'm going to ask James to see. James, you have a quick second? Were you able to do that, look that up? Get any information on that?
Answer yes.
Okay. So I'm going to give you what we think it is, but it's we want you to, as with all new things, there's different points of view in how we look at this, okay? So micro purchase, the language says, and I have it with me, procurement by micro purchase is the acquisition of supplies or services, the aggregate dollar amount of which does not exceed $3,000, it's actually increased to $3,500 now, or $2,000 in the case of acquisition for construction, subject to Davis-Bacon Act, to the extent practical. The non-federal entity must distribute micro-purchase equitably among qualified suppliers. So what James and I are trying to figure out is the $3,000, so let's say that we had to buy supplies, okay? Office supplies. So we have Office Max, Office Depot, Staples, Target. Those are the 4 vendors in our community, okay, that offer, where we can buy office supplies. I have to place an order today. I have an order, it's $2,500. I don't have to procure. I can go to Staples and get the material without procuring, okay? And I should have a policy and procedure of how I'm going to implement this. And I have on there that I'm going to go through these 4 and I'm going to go sequentially. So the next time, 4 months from now, suddenly I need more supplies. I've got file folders, I've got Staples, I've got these other things I need to get. This time I go to, and it's only going to be $1,200, I'm going to go to Office Max. Next time, 3 months down the road, I need more supplies. I go to Target. What I'm doing is I'm spreading the wealth. Once I get to the end, I go back to the first one to purchase the material at no more than $3,500. That's your maximum, okay? The question we're trying to figure out is whether that's, you can only do it maximum $3,500 aggregate for all of your purchases in a specific year, or it's per purchase, okay? We are still trying to get clarification on that. But that's a great tool to have, right? One way or the other, because quite often, especially public service agencies who buy $500 of supplies in a year, but not all of it at the same time, they can use this micro purchase as long as they present to you what their process is going to be and who the vendors are going to be and what they're going to purchase. They can use that option, okay? Counting records, like everything, make sure that you are documenting everything. Minimal records that you should have, internal controls, chart of accounts, transactions. So make sure that all your records are in line. Single audit requirements. Yes?
So a sub-recipient, let's say you're paying for food for their after-school program and their summer programs, and they're going to Costco or wherever to get the food.
Mm-hmm.
So for that, all I really need to have for documentation is the receipts of the purchase, right?
Mm-hmm.
But I don't need them to worry about this.
Correct, but what you also want to do at the beginning of the year is establish, okay, you're buying food. Okay, so we have, groceries that you're going to purchase. That's on the list. And who are the vendors that you're going to distribute it equitably to?
We're gonna go to Sam's Club, we're gonna go to Costco, we're gonna go here, and
They can just pick.
I would have that as a procedure.
Okay.
Because then when you're checking, every time they submit a payment request, a reimbursement request, I'm going to look at, well, they said Costco was number 1. Okay, it's Costco. The next time they submit, oh, they said it was going to be Vons. Okay, the next time they submit, they said it was going to be Kroger. The next time they submitted, they said it was going to be this.
Dollars worth of groceries over an entire year, and they say to me, I wanna go just to Costco. Can they do that, or do they have to split it up into years?
No. Then what they would do is they would use a small purchase procurement process. Go back to your old ways. This is just a way of saying, look, you don't have to do that if you don't want to. It's a small purchase. Go back to your small purchase. And by the way, we've worked with a couple of organizations that we gave that option to, a micro purchase, and they said exactly that. No, you know, we know what we need for our baskets. They do a lot of Christmas and holiday type baskets, Thanksgiving, and they said, this is where we get our stuff and we get it the cheapest there. So, okay. Single audit, you are required if you are an entity that receives more than $750,000 in a year in federal funds, you must have a single audit prepared. The requirements are now at 2 CFR Part 200, and they must be done by a qualified CPA. Audits due to Federal Clearinghouse no later than 9 months after the end of the fiscal year. And then the clearinghouse is supposed to send it to HUD. Okay? If you go out and monitor a subrecipient and there are findings in their single audit, they need to respond to that. That's part of your monitoring as well. Okay? If you have findings, you must resolve those findings as well. Okay? So the obligation is not only you, but subrecipients that provide services to your organization. Change in use. We talked a little bit about that in a prior slide. So let's say that you fund a subrecipient for the acquisition of a building, okay? And if it was in excess of $25,000, if it is changed, let's say that they're going to sell the property or the use is going to change, it must meet a national objective for 5 years after the expiration of the subrecipient agreement or a longer period if determined appropriate. Now, depending on the assistance level, your period may be greater than 5 years. But after those 5 years, they can, once it's met the requirements, they can actually sell the property. They must return any money at the current market value that grantee must treat as CDBG program income. That's if it's within the first 5 years. After that, it's whatever the agreement says. So you may have an agreement that says after 10 years, you're no longer obligated to do anything. It's either, you keep the money, whatever that agreement may be. But take into account that for 5 years, you still have obligations under the CDBG program, okay? And the same applies, yes?
I just want an example of a change in use. Like, would you consider, let's say you intended it to be home ownership housing, but they weren't able to sell it, so it's rental housing. Would that be considered a change of use? Because it's still housing, affordable housing.
It's the same agency?
I mean, it hasn't happened.
Yeah.
I'm just, for the future, because I know sometimes this happens where the market is such that.
That'd be more
Yeah,
of an
no.
old issue, probably, generally.
Yeah, I mean, it's not going from housing to commercial.
No. Let's say you assisted the Boys and Girls Club to buy a facility, and they had other funding sources, but you provided $50,000. Suddenly, you know what? This facility isn't it for them. They're moving out. They're going to sell it. That use, the next use is not going to serve low and moderate income people. Okay. And so the same applies to you as the grantee, but you have slightly different requirements. You must notify citizens and receive comments on the change. And if changed property use must meet a national objective for 5 years after closeout of the grant agreement, must reimburse its CDBG program for the current market value, and the regulation is found here.